So we're going to talk a little bit about, as you see from the theme, about family office and private equity, venture capital, kind of melting all that together. It's kind of interesting because of the fact that even though the theme is on M&A, we're going to talk about how all these kind of relate to M&A as well. So before we get started and introduce the panel, my name is Wayne Brown. I'm the managing partner of the Walker Group. And the Walker Group is a fintech boutique consulting company. So we work a lot with fintechs, helping them to partner with banks, financial service organizations. And so we play a lot on the revenue generating side. So we help fintechs grow their revenue, so increase their valuation. And increasing their valuation has a positive effect on what they need to do as far as exiting or to receive capital and so forth. So that's what the Walker Group does. And so I'm going to introduce our panel. And then after that, we have some questions that we're going to ask. One of the things that we also want to do and kind of state up, we have a number of questions that we have prepared, but we also want to make this an interactive discussion. So if you have questions based on what the panelists are talking about, what you're hearing, what you're thinking, we want you to raise your hand, not even raise your hand, just kind of raise those questions, kind of make this more of a discussion. Because some of the topics that we're speaking about, some of it was touched on yesterday, some of it was touched on earlier today, but we think that really that this want to make this meaningful and impactful to you as an audience. So to get started, let's introduce.
Oh, hi. Welcome, everybody. My name is Izzi. I'm the partner in charge of our M&A practice here in the New York metro region, which, like many firms, is kind of the largest hotbed of activity. Wayne told me I can't go over my Little League career, so I'll start with my professional career. I've been at this for over 20 years, long enough to actually have to take notes and use these to wear them or to read them. So in any event, in my past, I've also been a partner in a private equity firm and founder for 11 years before I started M&A consulting again. So welcome, and we hope to have a great discussion today.
Hi, my name is Chris Anci, and thanks for having me here today. 25 plus years in financial services. I ran a broker-dealer for about 17 years, which was involved in trading, 40 Act fund administration, and also investment banking. We wound that down in 2015 for a variety of reasons, preferably like commissions going to zero wasn't exactly a good business model. And then I was fortunate enough to join up with the New York City ultra high net worth family, and I spent the last 8 years working with them, building their family office as both CIO and COO. And we can touch upon some of the roles that I played in there as we continue the discussion.
Great. And then we have some on remote. So why don't we start with and introduce yourselves?
Andrew, go ahead.
Thank you, Jack. This is Andrew Finkel. I am a tax partner at Marcum. I work closely with Rich. I run our firm's national transaction tax practice, and I also lead our firm's national tax office. I've been practicing either accounting or law for the past 35 plus years. In the past 20 of them, I've solely focused on M&A transactions. So I have a lot of experience with buyers and sellers and private equity and industry and family as well.
Got it.
Thank you.
Yeah, my name is Jack Isaacs. I'm with Empowered Growth Capital. I'm an independent sponsor, meaning I don't have a fund, but I'm trying to do deals. So my background, I actually, like Andrew, I practiced law for a period of time, about 15 years. I eventually worked at a tech company in Silicon Valley and then ended up getting my MBA and moving into private equity. I've been in private equity now for about 18 years. And one thing I would say before I go, there's lots of M&A lawyers out there. I'm an M&A lawyer by practice and training, but a good tax lawyer and a good IP lawyer are worth their weight in gold. So finding a good tax lawyer, call Andrew. That's a smart thing to do.
Great.
I'll pay you that $20 later, Jack.
Thanks for the introductions. First of all, I want to make sure that everybody can hear. Yes. Yep. Okay, so those that are on remote, if you could just make sure to speak up so that the audience can hear, that'll be very helpful.
Yep.
Okay, perfect. So Jack, we're going to start with you. You had mentioned that as an independent investment opportunities, and really how has the sourcing changed over the last few years?
Sure, absolutely. As we wanted to say in the beginning that nothing in the presentation constitutes legal advice. Any legal advice that may have come from this is general in nature. Your specific needs might vary significantly. I also want to make the point that the views expressed here are the presenters alone and don't necessarily represent the views of their organization. In terms of,
we're going to pause for a second. We're going to pause.
Yeah, Jack, hold on a second. We can't hear. Can we turn?
you can't hear me.
So what
Yeah,
can we-
that's what I just mentioned.
Andrew, you can hear me, right?
Yeah, you're
we
coming
hear you.
through fine on Zoom. It's, I think the general live audience is having issues.
Oh,
Just keep talking and I'll deal with it.
okay. Let me give you some guidance in terms of the markets right now in private equity. We've gone through an interesting time economically, just in terms of the public markets, which impact the private markets. Public IPOs back to a couple of years ago just went skyrocketed. Last year, they were about a fifth of what they were 2 years ago, and this year they're slow again. That impacts my business, impacts transactions, impacts the M&A market. People invest in private equity, they need to have an exit. An IPO is a nice way to have an exit. If the IPO markets aren't active, it's very hard for private equity to continue to do deals. And basically what they do is they invest in a company and then they sell to another private equity group who sells to another private equty group. And you end up in this kind of merry-go-round, which is not the ideal situation. In terms of for an independent sponsor, and I don't know, can you folks hear me?
Yes. Yep.
Okay, good. In terms of as an independent sponsor, basically, I send out email blasts, I make phone calls, I scour the ocean. But I also have to have relationships with investment bankers. I have relationships with lawyers, with accountants, with service providers, anyone that might have a relationship with a smaller, early sized business.
Eureka.
Oh, okay. Now you can hear me.
Yeah, there you go.
Okay. Okay.
Can you go backwards about 3 sentences more?
Thanks for the presentation, very much.
Yesterday about 9 o'clock.
Thank you. Thank you.
We didn't buy something we didn't want.
I will just continue. In order to source, when you're an independent sponsor, source funding, that's a whole other skill set. And you want to reach out to everyone you've ever met, every girlfriend that you dumped, every bully that bullied you in high school, every single person, in hopes that someone's going to introduce you to someone. My strong advice as an independent sponsor: get to know Marty and start joining Ivy's Family Office Forum, because that's a nice place to meet a lot of family offices that have capital to invest. I will say, just so you folks understand, I actually currently have 2 deals that I'm working on that I can use capital. So this is a plug. My deals are generally I look for companies with between $5 and $15 million in recurring revenue. I invest $5 to $15 million. I am always, unless I'm buying a company as an add-on to a portfolio company, I'm always a minority investor. One of my very first deals was a company called Smarsh. The company was owned and run by Stephen Marsh. It did not make sense for me to own more of Smarsh than Stephen. I kind of kept that in mind in terms of my deals going forward. I work for the companies, they don't work for me. I don't have the need to have them as my employees. I generally buy between 22 and 33% of a business. I have structure in place, usually participating preferred structure, often with a dividend. I'm in for 3 to 5 years, and then I exit with the founder. That is my structure. And, I think that's a place where I can add some real value in the business. I'm not looking at EBITDA. Most people in my industry look at cash flow. And then they use a multiple of cash flow. I look at recurring revenue. I generally looking at technology-related businesses. And when you have recurring revenue, you can project future profitability fairly easily. You kind of just continue, like it's a credit card or your cable bill. So it's a pretty nice place to play. I will leave it at there for now, and hopefully when we come back around, I can talk a little more. Why don't
Thanks.
Wayne, why don't you kind of go on to the next?
Good. No, thanks. And we'll get back to you because one of the things, obviously, to kind of find out about the source of finance, but we'll get back to you on that. So this is a question for Richard. Richard, what does the general M&A market relative to the private equity market activity look like? Can you kind of comment on some of the things that you're seeing as some of the recent trends?
Sure, absolutely, Wayne. So, our firm generally does, I would say now, between 120 to 150 projects a year of all sizes. We've actually have performed, in any year, we probably do $3 to $4 billion plus deals, and that's been consistent. But we also do smaller deals. And basically, my background in terms of the information I'm going to share is based on middle market activity. So most of the firms that we're dealing with are about 150 million to say 400 million in revenues with varying levels of EBITDA, unless we do a lot of cannabis work and some of them have no EBITDA. So it all depends on the industry in terms of the returns. Data on private company transactions are hard to find. As you know, there are some data tracking that we look at, the different data sites, and we use them internally for valuation purposes in our valuation group, and as well as I do in my group to monitor activity. One of the ones we look at is PitchBook. It tracks M&A activity, reported activity on private company transactions. So we use that as a kind of proxy for what's going on because a lot of these transactions aren't reported. So that said, through the first 2 quarters of this year, I would have to say that it's been one of the worst in terms of activities for middle market transactions. And if you can believe it or not, the statistics tell us that the level of activity has gone in the first 2 quarters, went below what it was in the first 2 quarters of COVID in 2020. And different things are driving it in this case. That said, it appears to be picking up through the second quarter of this year. The number of transactions that have been logged in and they're aware of, it's just under half of what it was. I'm sorry, just under the same number that it was in the first 2 quarters of last year. I think there's about 250 deals short of what it was in the first 2 quarters of last year. And in the third quarter, it'd be interesting to see the numbers. Things have picked up quite a bit for us. I would tell you the other things we can share, 2 things. There's been a shift in the industry over the past 5 to 7 years. We used to do, we do work for family offices, private investors, PE firms, strategics, and let's just call them others. So banks and refinances. There's a lot of refinancing going on right now because people, their agreement has expired, they're refinancing, and they don't have a choice. But in general, the level of activity in the past few years, at least since 2013 when I looked at the numbers, in terms of add-on acquisitions by the PE firms has been increasing. And in this first 2 quarters, it's topped out at 78% of the transactions are add-ons to existing platforms. And that, if you look at the curve on that, that's just continued to go up quite a bit. And there's reasons why that's unique to PE. Multiples of EBITDA in terms of the predominant valuation model that's used have gone down a little bit in the first 2 quarters, but they are still well above what they were, pre-20, 21, and 22 madness, in terms of the level of activity. And lastly, I think, Wayne, you had asked to comment on trends. What's driving the market now and impacting it the most are interest rates. We witnessed that in 2008. We're witnessing it again. A lot of the supply chain issues, at least with our clients we've seen, have moderated quite a bit. Inflation's still there, but certainly the interest rates and economic uncertainty, we've got an election coming up again soon, and world affairs like never before with Ukraine and China and everything else are really slowing down the market. The last thing I'll mention is as an upside in terms of wealth, the trillions of dollars of wealth that are held in the U.S. in private companies, the demographics are working for us in terms of service providers because there's an aging and people need about 80% of the wealth I read at one point in time is held in private businesses in the United States, and everybody needs to retire or sell at some point. And that means there's a level of activity, and it's become a seller's market in the past 5 to 7 years for good companies. So that's driving, the demographics are going to continue to drive demand and transactions. And of course, the last thing everybody in this room knows is there's this massive pool of cash out there. And to the extent that it's in a private equity firm, limited partners expect that capital to be deployed. That's what has pushed up multiples in the market and is continuing to do so. So, in terms of trends, I don't think those two big trends, the demographics in the U.S. relative to businesses and this pool of capital that needs to be invested are going to slow down or change significantly anytime soon. So.
Makes a lot of sense. Many are looking for 2024 and beyond to be a little bit more optimistic on that side, but that's a good point. So Chris, why don't you talk a little bit from your viewpoint of what you've seen with the impact of interest rate increases on, and what that has an impact on private equity, and then maybe talk a little bit more about what you are seeing or trending in some SEC regulations as well.
Yeah, I think one thing that we should do is just take a little bit of a step back and look at where private equity was and where it is today. And the exponential growth in terms of assets, I think it went from like 2 trillion to 8 trillion. But you can correlate that with also the growth of family offices as well. There's been a proliferation of family offices because people are feeling more comfortable taking on the role of managing their wealth as opposed to parsing it out to funds and et cetera, because I think people have gotten burned in the past, 2008 in particular. One of the things that we saw working at the family office is that courtesy of the regulation, the public markets, right, have become either index products, closet indexers, or like a regulatory nanny state, for lack of a better term, where passive investing is kind of getting rewarded. So in order to capture the historic alpha, right, private companies are staying private much longer, and then they go public with multi-billion-dollar IPOs. When they go public, it's the ETFs that end up buying them. So investors realize that in order to capture alpha, you have to go earlier and earlier into the stack, right? So that's one of the reasons why you're seeing such a proliferation, in my opinion, into families putting their money into private companies. So in my experience, what we did over the last a number of years is ultra high net worth family, multi-generational. They were looking for non-correlated investing. They started doing some, just prior to I got there, they made a couple of venture investments, but then I quickly showed up and realized that their temperament was not really built for venture. As we all know, the distance between no revenue and revenue is pretty long and hard, and then you eventually get into the conversation about the inevitable pivot, which is the phone call that you never want to take from an early investment, is when all of a sudden the business plan that you invested in is now quite different. So we focus primarily on Series A companies, right? We found that the space between Series A and Series C, ins and outs, is probably a good place from both an IRR perspective, timeline, and seeing that, because the distance, I think our colleague said, companies with like 5 million in revenue, the growth from 5 to 20 is exponentially, is shorter than pre-revenue to the 5, and a lot less painful. So I think when you hear people say that taxes don't matter or regulations don't matter or affect investor behavior, they clearly do, and everybody is driven by that, right? So I think that the way that the public markets work, I think at one point There was over 8,000 equities. I think we're sub 4,000 equities now. It's very consolidated, I think. Meanwhile, there's private companies that are just booming across the board. One of the things that we spoke about, partly because, I think every office needs a couple of gray hairs in the room because experience and time matters. And then when you're dealing with some younger people, they've never really seen a normal interest rate environment, right? And there's a lot of businesses, business models that if rates were normalized earlier may not have survived, right? And a lot of companies have been able to sustain themselves because of the endless amounts of cheap money. Now, even though we have had these dramatic rate increases, there is still tons of money on the sidelines, which is still driving things. But rates have affected a lot of valuations. There's not a lot of activity, from the Series C and later because they will be down rounds, and a lot of people don't want to print the down rounds. A's and B's are still doing okay. I think there's still some risk appetite out there for that. But overall, and we all know this, right? It takes 6 months for the first rate increase to hit the shore. We've had an enormous, we're maybe feeling the third. We may feel them all at once. I don't know. I mean, I'm not a commercial real estate guy, but that guy's looking at a tidal wave. So I think there's a lot of work that we have to do over the next couple of months, and then you get the hair of this election and whatever else is going on, and we don't want to get into that. I think it's going to be an interesting and challenging period. But with that said, it's environments like these is where the next Google gets funded, or the next Tesla gets funded, or the next, biotech from our healthcare company that we talked about earlier. This is where they get funded. So I think it's an important time for people to really go back to doing the work. It's not so easy. I don't know if you guys on the buy side, how many times you hear people come into it's 5, well, we're doing this, it's 10 times. Everything's 10 times rep, 10 times rep. I'm like, I'm not sure everything's 10 times rep, right? So we've actually had a couple of conversations on that front these days too, where people have come in and they've put like these 19 or 20 or 4. If you owned a house with a 3% mortgage, right? And now that house has a 7% mortgage, is it still the same price? Right, so we've been able to negotiate down some of these valuations. So maybe collectively we're getting into a little bit more of a saner world where there's going to be some really good opportunities.
Thank you. So you kind of mentioned with regards to some impact on the tax side. So Andrew, perhaps you could speak a little bit more about the interest rate increases, the effect on tax deductibility, on interest expense, and so forth, and then talk a little bit about the tax policy landscape and its impact on private equity.
Sure, Wayne, I'd be happy to do that. So generally the interest was able to be deducted from taxable income in an unfettered manner, so long as it was not with a related party. But that changed in 2017 with the Tax Cuts and Jobs Act, and because there were so many taxpayer favorable provisions in that act, lowered the interest rates for corporations, it lowered the top marginal rate for individuals. There had to be some revenue raisers, and interest deductibility was one of the revenue rate raisers in this act. And so what it did is it imposed a 30% or an interest expense limitation computed at 30% of earnings before interest, taxes, depreciation, and amortization. So 30% of EBITDA. So that was effective for 2018 through 2021. In 2022, that computation changed to 30% of EBIT, which is more restrictive, right? So you're computing 30% on a lower number because there's no more add back for depreciation and amortization. And so there have been, I think I counted 11 rate hikes since the beginning of 2022, which obviously increases the cost of leverage. And so add that to the new rules on deductibility of interest, and you see that that is an additional cost. That cost became even greater. So, Rich talked about the fact that there's a lot of capital sitting on the sidelines right now. And Chris had talked about that there is some, valuations are being affected by the interest as well. So this would be an opportune time to, if you do the math right, to have PE firms or family offices fund future transactions with a bigger cash outlay than debt outlay to try to get out from under these interest limitation provisions in the in the code right now. I don't think that this limitation is going away. It was suspended a little bit during COVID, but we're kind of right back where we are in a worse interest rate environment. So that kind of closes the loop perhaps on rise in interest rates from an overall standpoint to how it affects the market in general to how it is affected from a tax standpoint as well. With respect to the overall tax landscape, I have kind of good news and bad news. So let me start with the bad news first. The current administration is looking to go after corporations and high earning individuals by increasing the tax rates. They want to expand the net investment income tax to high earners. They want to reduce the now 100% exclusion for the sale of qualified small business stock and many other revenue raising provisions that are really keyed upon the higher earners. And so that's the bad news, right? They want to clobber us all over the head with tax rate increases. But the good news in all this is it's doubtful that anything is going to get done. Because we have a split Congress, and we have a House are Republicans, Senate is Democrats. So the likelihood of any major changes that are being proposed, quite frankly, on both sides is very remote. One of the things that near and dear to probably everyone's heart in the room is carried interest legislation. Back in the TCJA that I spoke to, they did increase the holding period from 1 year to 3 years with respect to the ability to get capital gain treatment on the carried interest. There were proposals out there to increase that to 5 years. Every time that legislation seems to be attached to a bill, it miraculously disappears. And so, in this recent legislative session, the Biden administration, or the Ways and Means Committee, actually talked about putting a 5-year holding period on there, but the Biden administration green book that they put out did not have that in there. So it seems for now that carried interest is safe from further regulatory. Yeah, for now, right? Tongue in cheek. Anything could happen, and anything can happen tomorrow. But I think Congress has some other things that they need to take care of, like keeping the government open before they perhaps get to that.
No, great points. I see some questions that are coming through. Yes, please.
Andrew, what solution would you recommend from a policy standpoint that people of wealth could influence policy in this country to protect the country from going into, and I'm talking apolitically now. For instance, I can provide an idea, but I mean, I'm looking to see what you, from a tax standpoint, would look at as an organization that could be created to influence policy.
Yeah, I mean, so policy is still, at the end of the day, done on a legislator by legislator kind of theory, right? It's the person that's going to step into the chamber that's going to cast the vote that it ultimately has to spin. So, I mean, there are PACs out there, and there are organizations that are lobbying in Congress with respect to private equity and carried interest legislation, which probably has a great deal to do as to why there hasn't been a major overhaul. Every private equity person, partner that I've spoken to about this knows it's coming somewhere, that capital gain treatment is probably not going to be there forever. They know what they're getting away with right now. I mean, they're not getting away with anything because it's the current state of the law, but they know that the shoe is going to drop sooner or later. These lobbying groups have done a good job. And, the Congress is very attuned to, to private equity, right? They're trying to regulate private equity because it's not in the public markets, but they're trying to regulate it. But at the end of the day, it's still a private market, and it's as it increases and becomes more and more prevalent in today's investment society. We're going to hear more about it. Whether or not action is going to be taken, I don't know. But that's I hope that's it's not a great answer to your question, but it's about probably the best I could do.
Thank you.
Thank you. Jack, you talked a little bit earlier with regards to, as an independent sponsor, how you source investment opportunities. Can you talk a little bit more about what you're seeing as far as this financing, how financing of those opportunities have changed, over the last few years?
Yeah, sure. Well, when I started in private equity a million years ago, there was a huge gap in information available. So if I went to talk to a company in Des Moines, they never heard of the term EBITDA. They had no idea how to evaluate their business. They would use the lawyer that drafted their wills to negotiate a term sheet. That information gap has dramatically disappeared. And as Christopher pointed out, there's a significant number more private equity groups out there. You look at the front page of the Wall Street Journal, and there's references to the public market multiples and what's going on in the private markets. I talk to Des Moines, and the first thing they say to me is, I'm worth 10 times EBITDA. And I'm going, yeah, you're a local business. You have 7 customers. You're not worth 10 times EBITDA. Expectations are a bit askew. I think that is kind of changing right now, fortunately. Private equity right now has been slow. And I know there's a lot of capital out there that needs to be put to use. People don't want to be giving money to private equity firms that are just sitting on it and not utilizing it. I'm anticipating a very active fourth quarter here, both in the private markets and also the public markets. I believe there's a whole lot of IPOs that are coming to market. We've been somewhat constipated. And so, the fundraising side of it as well. I'm going to have to go out and raise capital. And Christopher, I'm going to be giving you a call. I need to raise it from wealthy individuals. I need to raise it from family offices. The fact of the matter is, now is a bad time to be making some investments right now in the economy. We have the CHIPS Act, or the CHIPS Act, which is really going to be very beneficial to my sector. I think the Fed has done an amazing job of keeping us on the straight and narrow. When you look at the world economy, there's reasons to be concerned. Germany slowed down dramatically economically. They're the powerhouse of Europe. Things in China are not great. We have all sorts of things going on, obviously, in North Africa with hunger and Mother Nature. But the US economy is chugging along. And I think there's some real opportunities I'm pretty excited about. So quite frankly, going out to the private markets to raise capital, I think now's a good time to be writing some checks. And of course, I obviously have a vested interest in saying that. But in any event, I think that kind of covers it. By the way,
And then some.
I think I was just going to say, I've not met the rest of the panelists before this, but I'm very impressed with actually everyone said. I actually am violently in agreement with everyone on the panel so far.
Does anyone have any questions? Because we're going to shift gears and talk a little bit more about family office before we do that. Okay, good. So Richard, can you discuss family office direct investments and how are family offices approaching direct investments as compared to private equity?
Sure. Again, I'll keep it brief, and then if there's questions, because I don't want to keep this on track. So we do a lot of work, as I mentioned before, for and much more. It's been increasing with family offices, and we have a number of funds who are investors in opt-in funds, where you pay to play basically to become part of the club, and then as deals come in, there's a minimal investment from the small fund, but then all of the participants get an option to participate, given certain rules, to participate in the transaction. And so obviously these funds are more generalist funds as opposed to PE funds. And so those are kind of two ways we interact with family offices and wealthy individuals. We had a unique one last year where a family office that was in a certain industry decided to do an acquisition of a complementary business at over 400 million in revenue, and they actually used the SPAC vehicle to do it. Okay, and it was one of the first times where we had, I would define that as a high end of the mid-market. It was the family owned, the family used the SPAC to get the transaction done. That slowed down with what the government's done with SPACs. But I would say generally that the types of due diligence that family offices are doing or having done are really no different than a PE firm would do, than a strategic would do, that type of thing. There's little differences, but not significant, okay? The focus of that diligence, though, varies quite a bit in the way it's handled. One of the biggest things, and we see this behavior more like a strategic acquirer than a PE firm, is that the ability to tolerate different types of risk in these transactions is much different with family offices. Typically, they know the businesses generally better than maybe a PE firm would. They also aren't worried as much about what their limited partners may think because they don't have limited partners or they're not big players in a transaction. So their appetite for risk is better when they understand the risk. And we don't tend to get bogged down as much in certain things on PE transactions where there's a requirement to really assess it more thoroughly. Also, the family offices aren't staying in their lanes. If you're a PE firm and you have an investment thesis and investment criteria, you're staying in your lane. Family offices aren't. They don't have those boundaries as much and don't follow them typically, as much as others. So that's a difference as well. And then we all know about PE holding periods and return on equity, and that tends to be not as big a deal with the family offices that we deal with in that regard. And I guess other than that, Andrew, is there anything from a tax perspective in dealing with family offices that comes to mind?
Yeah, I mean, from a tax standpoint, Rich, we want to make sure that the structure is properly integrated with the rest of the organization. Family offices are oftentimes structured very differently than other corporate structures, strategic acquirers, or private equity. So it's and especially because private equity, their end game is to buy, grow, sell. Family office oftentimes is buy, grow, and then figure it out somewhere 10 or 15 years down the line. And so there might be a different exit plan for a family office than there would be for a strategic buyer or more prevalently a private equity firm.
I guess the last thing thanks, Andrew. The last thing I would say is that we see more of a prevalence for family offices to be open to dealing with independent sponsors like Jack A lot of the, I was a partner in a private equity firm, and a lot of the PE firms view, sourcing deals as their obligation and their commitment to their limited partners. And they're reluctant a lot of times to pay fees to independent sponsors when they should be sourcing deals themselves. That said, that they do, but family offices really don't care where the deal comes from. If it's a good deal, good companies, it's been a seller's market for at least the last 7 to 8 to maybe even 10 years. And we've noticed that family offices, I hope that's accrued and helped you, Jack, but we see that more often than we do with PE firms.
Thank you. So Chris, can you talk a little bit more about your observations in family offices, what you're actually seeing for their need for private equity and so forth?
Yeah, and let's just touch to the sourcing of deals. And I mean, look, it's America, right? If you hang out a shingle that says you have money to put to work, your phone's going to ring, right? So there was no shortage of decks, and obviously, given the Rolodexes of either the principal, the family, or yourselves, you tend to be able to source a lot of deals. We were particularly opportunistic, right? So we had a handful of consumer products. Some did very well during COVID because if the government gives out free money and tells everybody to click on, e-tail all day, there's some companies that did quite well. We were going to some SaaS companies and stuff like that, but I looked at it as two ways, right? You have thematic investing, right? Where you actually have either an investment criteria and you're going out and you have a shopping list and you're proactively going out looking for what you want to buy and own that meets your objective. Or I coined another phrase called deck roulette, which is basically these decks just keep rolling in and you have an obligation to go and look at them because God forbid there's a 10X sitting on your desk and you didn't look at it. So there's a lot of this stuff where you have to at least give everything its due. And a lot of times there's ideas out there which, maybe age has a little bias or your gut or whatever. You still have to kind of put your hat on and go through the work and find out is this viable? Because from the looks of the room, there's not many millennials in here, but like they have a whole different mindset than we do. And what their version of like what is a good opportunity or a good company or something that would grow is different. So a lot of times you got to do a little bit of extra work on that front. I think at the end of the day, I think that when you look at certain groups too, I always find this interesting. You find out these different investing groups and you go to their websites and they all have their holdings. And then you look and you think that you're well versed, you think you're in the know, and then you look at somebody's portfolio and you're like, I never heard of any of these companies, right? And then you go in and you poke around and you find that like half of them are probably, half are probably goose eggs, but half are real. Right? And you're like, why didn't I find those deals? How come I wasn't in that loop? Right? So I think that you have an obligation also to go out and do your own homework. And we all have these things in our hands called the phone. So you got to really put yourself out there and turn over every stone because there's a lot of opportunities out there.
Yeah, makes sense. Jack, do you want to talk a little bit about any advice that you may have for family offices that are considering investing in venture capital or private equity?
Yeah, do your homework. I mean, as Andrew was just, or as Christopher was just saying, when I go invest in a company, I roll up my sleeves and do a heck of a lot of work, and I provide them a list of companies I've dealt with in the past, good ones and bad ones, because I want them to know, how I did when things did not go well. Because no one is going to hit it out of the park every time. Same is true for family offices. If you're giving money to a private equity fund to invest on your behalf, you should have some idea of what the hell they're doing. There's quite a range in terms of folks in my industry, and not all of them are good. A good number of them invest and then sit back and watch other people make money for them, which, go invest in the public markets. Don't waste your time in the private markets. If you're going to put money in the private markets, roll up your sleeves and do some work. Some of them are bullies. Some of them go in and think, oh, I know how to run this business better than the founder owner who built it from nothing. And then they put in their own people and then they screw things up. you know, having an MBA doesn't mean you know how to like run a business necessarily. And I think a lot of private equity groups make some pretty big mistakes because they just think they're kings of the world. I'm pretty happy with, you know, not having all the answers, but I like to be of help. I like to be of use. I think a lot of it has to do with the training that Andrew and I got as lawyers. When we represent clients, we are the mouthpiece for the client. We are the advisor. My goal is to help those companies grow and do everything in my power to make them grow. So my recommendation is get to know who you're giving money to and what their approach is, because some of the biggest funds have the worst reputation.
And track
I don't
record.
like yeah, and I don't like the idea that my industry is being damaged by some of these people. So for my sake, for your own sake, you know, figure out where your money's going.
Okay,
Great job.
so appreciate the comments. And so again, the panel's going to be here. So if you have any other